your hand. That one's a little harder to see, but you can use that as well. But please ask any questions you have. We're going to try to make this go about 30 to 35 minutes if we can, but there's a lot to talk about. So first, we're going to talk about general revenue ideas. We're going to go into deferred and unearned revenues as well as sales discounts, and then we're going to mostly focus this review on allowance for bad debts. If you go through the exam, the practice exam, you'll notice that probably 90%, or if not 90 to 95%, of the practice questions are all about allowances for bad debts. So that's why I'm going to focus on those. I'm not saying when I glaze over these a little faster, I'm not saying they aren't important. There's probably going to be like one question, but if you think, he has a select amount of questions he can give for all the content, I would say there's going to be a bunch about allowances and probably one of the other ones. And so let's get right into it. All right, revenue recognition. So at this point, hopefully you've heard this idea and had it click for you, but we recognize revenues when we earn them as a company, not when we get cash necessarily, but when we earn them. A great example of this is the difference between going to Smith's and buying a Twix bar and getting pest control services. When we buy a Twix bar, we hand them the cash, they give us the Twix. In our heads, that's when we think about revenue. We think, oh, well, I earned my revenue because I got some cash for giving him the Twix bar. And in this case, it's true, but only because we gave them the Twix bar right when they gave us the cash. Them giving us the cash doesn't actually represent revenue being recognized. A better example is pest control. If any of you have ever heard of pest control services, they show up, they spray your house, they leave a little door hanger, and then you pay your bill 2 weeks later, maybe, or at the end of the month. In that case, we record accounts receivable, like you'll see in this journal entry right here. Now, we haven't technically received cash, but the reason why I record accounts receivable and revenues is because I have performed my service for them, aka I've earned my revenue. I did the work, I did the service, therefore I can record the revenue. The place where this gets tricky is the opposite case. When I get money from someone, but I haven't really earned it yet. That is where we talk about unearned or deferred revenues. And so we'll talk a little bit about that later. But just want to set the principle up front, revenue recognition. I don't think they'll have a conceptual question, but they might. Just remember that when a performance obligation has been satisfied or when we have earned the revenue, that's when we can record it and not sooner. So here we are on deferred revenue. The best example of this is airlines. Most of us have probably taken a flight at this point in this modern era that we live in. And you know that when you get your flight, you pay for your ticket sometimes months in advance. Well, we know that we have to earn our revenue before we can record it. And in this case, we haven't done any services for them yet. We've just received cash. And so when we receive cash, we record a debit to cash because we did receive some amount of dollars. And we do a credit to, instead of revenue, deferred revenue. At the beginning of the course, we heard it called unearned revenue. It's the same idea here. And then once people actually take the flight, then they get to record revenues. They get rid of the deferred revenue and they record the sales revenue. Now, before I move on from here, just a quick pop review quiz. What kind of account is deferred revenue? Think about that in your head for a second. What kind of account is it? All right, so deferred revenue, hopefully you thought it was a liability. Now, if we think about all the potential accounts, we've got our assets, liabilities, equities, and then we've got our incomes and expenses. If you think about it, if we haven't earned the revenue, but we received cash, technically, we kind of owe something of value to our customers. We owe the services. And so deferred revenue is a liability. Again, I don't know if that'll come up, but it's an important concept that I think you guys should understand. Discounts. Discounts are really interesting in the accounting world to me, but I'm a nerd, so maybe they're not interesting to you. Essentially, how discounts work is when we make a sale, oftentimes when they have a certain amount of time to pay us, we like having more money in our company. And so we'll incentivize them to pay us sooner by saying, hey, I'll give you a little bit of a discount if you pay me a little bit sooner. That's essentially what we worry about in this class as far as discounts go. So often what you'll end up seeing is you'll see on the day of the sale, you'll see accounts receivable recorded for some amount, and you'll see sales recorded for some amount. But then later, when they pay us, if they pay us in time to qualify for the discount, we'll record the cash they gave us. And the easiest way to remember how to do this is kind of a fill in the blank. So if we have, let's say that this AR was $100. And I was going to get a 5% discount if I paid soon enough. Then I get that 5% off, so my cash I get is $95. If we just think about this like we would think about any discount that we would purchase. Now I need to get rid of my accounts receivable because they paid me, so they don't owe me anything else. But when I get rid of that accounts receivable, we have an imbalance. We have a debit of 95 and a credit of 100. We know that we need a debit of 5. That's a helpful way to remember that discounts is a debit balance, but also that discounts are going to be a contra revenue account. So just to clarify, they are not an expense. That's been a question. If not, that's okay. But I saw someone's mic pop on. All right, if you have a question, feel free to speak up or put it in the chat below. So when we record these discounts, they aren't going to be expenses like you think of rent expense or that kind of an account. Instead, they're going to be paired with our revenues. So as you see here, this is what it looks like on our income statement. We have our revenues, or our sales, and then we subtract our contra revenues. That's going to be our discounts as well as this applies to our returns. And we'll get our net revenues from that. The reason why I go through this is I've seen before they'll ask you questions like they'll have a big bad debt problem, and then they'll have a big discounts problem, and then they'll ask you for net sales, and people will put this number. And so keep in mind, net sales or net revenues is the revenues minus all contra revenues. And the contra revenues are discounts and returns. And so keep that in mind, because that would not be fun if you got one wrong at the very end when you did everything else right just because you couldn't remember what net sales or net revenues were. All right. I have 2 problems that I put out there. You guys have tons of problems to go through in the practice exam. So I like to give you tricky ones in hopes that they'll demonstrate the harder principles. And so I have one of those coming up here. Does anyone have any questions before we move on about discounts and about contra revenue? See Slime's typing. Love the name. Though it is second to Stice's favorite. I will throw that out there. Never seen that before. So why are discounts? That's a great question. So the reason why discounts are a debit is because discounts reduce the amount that we are getting in sales. And sales is a credit account. A good way to think about this is if you think about how property, plant, and equipment works, we have PP&E, and we have accumulated depreciation, right? Property, plant, and equipment is a debit account. So if we had $10,000 of property, plant, and equipment, then we record it as a debit. Accumulated depreciation, if you recall, is a credit because that's directly reducing the amount of property, plant, and equipment by 2,000. And so it has to be a credit account to be able to reduce the debit account of property, plant, and equipment. A good way to remember that is that discounts are a contra revenue. And so what is a revenue account? A revenue account is a credit balance. So you can think of discounts like an expense as far as the debit, as far as remembering that they're a debit and not a credit. The thing I would say to avoid is you can think of them like an expense, but they aren't an expense. They are a contra revenue, and the only reason that really matters, because that sounds like it's like, well, if they're treated the same with debits, then why does it matter? And it's the location on the income statement. And so let me clear this real quick. So you can think of it as an expense as far as the fact that it's a debit, but just keep in mind when we have our income statement, we've got our sales minus our expenses equals our net income. And then if you remember, when they break it out farther, they'll have sales minus contra revenues equals net sales, and then that minus our operating expenses equals operating income, and so on and so forth. The only reason I emphasize that it's not an expense, but that you can think of it kind of like an expense, is because it's paired with the sales. It's not an expense, and it's not included in operating expenses. It's included in the sales, and we do sales minus discounts. But it's treated exactly like an expense. It reduces the amount of sales. Does that help? Okay, perfect. If you need more clarification, this next problem will, I think it'll help demonstrate that a little more. I got you, Stice's favorite. Anything for you. All right, here's our practice problem. So, like I said, it is a little tricky. It is okay. Good. I'm actually Stice's first favorite, but I didn't want to say it. Just kidding. I didn't even take the class from him. I took it from Larson. So, go ahead and go through this problem. I'll give you guys 3 to 4 minutes to get started on it. Like I said, it is a little bit complicated. Just to give you some hints. They're going to have a sale of $100,000. Don't complicate that transaction. Record the accounts receivable, record the revenue. What's harder is what's after that. When you have to record them receiving cash the first time and getting it on the discount, and then receiving cash the second time, and also having a return on that. And so separate that into those 3 categories, and I think that'll help a lot. Also, for those of you who are looking at this and are confused by this term, 210 N30, the way that I like to remember this is that the N represents normal or normal price. And so if you think that N is the normal price, then 2 over here is going to be that discount rate. And so we get a 2% discount if we pay in 10 days, and we have to pay the normal price within 30 days.